Welcome to day 7. Today we're going to be looking at what type of trader you're going to be, different styles, as well as how to build strategies based around some of the things we've already been looking at, all those tools that we've gone through so far. So you've got the tools you need. It's now a case of turning that into some money. This is where it gets interesting. This is where your career as a trader really starts to develop. So let's crack on with the day. First up, we're going to have a look at style. We're going to have a look at what the requirements are to use each different style of trading. This is going to help you in deciding exactly where you want to go with your trading and what style that you want to use. It is then also going to help you develop strategies. Certain strategies do not work with certain styles, and so it's going to inform you as to where you want to be looking at your different strategies. So I'm going to focus on scalping, swing trades, event type trading, and more systematic trading. I'm going to step away from algorithmic and fundamental trading. This is a little bit less for the individual, that style of trading. Next up, we're going to move on to strategy. First, we'll be looking at different types of strategy. I've broken this down really into 4 different types. And again, the requirements you're going to need to be considering for each of those. And that's where you can start thinking about, does that actually suit me? We're then going to be looking into the ideas and the actual creation of a strategy. Beyond that, once you've got your strategy, it's then a case of implementing it. We're going to be looking at the execution of the strategy, how to improve on the strategy, how to evaluate it, and also the risk that you're going to be taking on in implementing these strategies. Finally, trader development is going to be your chance to create some strategies. So I'm going to give you a few hints and tips or a few ideas that I think you should be having a look at, but then the rest of the day is really down to you to go ahead and go and actually start building up some of these strategies for yourself. We'll start off with scalping and swing trading. I put these two together because they do share some similarities, particularly in the sense that some scalp trades can have swing elements to them, a sort of slightly larger time frame scalp. But we're going to start off with scalping and have a look at the key sort of elements and what it's going to require from you to be a scalper. First up, it is very time intensive. This is your typical day trader's style of trading. You're going to need to be here all day trading. And the idea is that you're going to be paying attention to a lot of markets, to a lot of different trades throughout the day. So you've got to be focused on all these different trades that you could be doing. It's a lot more of a dynamic style of trading. The idea of it is to be consistent. It's short term. So you're taking multiple trades on with the idea that on aggregate, you're going to make more winners than losers, or you'll manage your risk to allow you more winners than losers. So it's about building your day up rather than one trade that makes your day. That's the idea behind scalping, that if you can take multiple trades, eventually it will work out for the best. This is a very execution focused style as well. As I said, it is dynamic. It's not entirely off a technical perspective, just off charts. You're going to be looking more at flow. This is where the ladder comes into play a lot as well. You're going to be taking those smaller trades on the day. And again, the idea is just to be consistent, keep taking those trades. But the precision, the focus on the execution is very important because of the fact that you're only looking for a small amount, and again, you're only taking a small risk. So execution is extremely important. And finally, it does give you a lot more discretion. Gives you a lot more chance to, you don't need something necessarily to tell you you're wrong or tell you you're right on a trade. You can use your intuition a lot more. So you've got to be comfortable using your intuition, comfortable taking quite a few losses throughout the day and not allowing this to affect the fact that you have seen certain things and it is going to produce a trade. Now, the difference with a swing trade is that this requires a lot more patience. Once the trade is entered, the idea is you're going to have to leave this trade to reach its objective. If you keep getting out of a swing trade, what you're doing is you're taking on a larger risk on the trade, but consistently not taking the money out of it. So if you have a period where you say get stopped out of quite a few trades in a row, because of the fact you're not holding the trade fully to its potential, you're actually increasing the risk on the trade. So patience is very key, and waiting for the trade to actually play out. So this perhaps a little bit more suited to someone who can take the time to step back, plan their trade, and then execute it and be confident to just let the trade run. As I say, it is less frequent. It is a lot more technical based as well. So you're going to be waiting for your candle close to confirm a trade. You've then got a trade confirmed, you know what you're looking for, and you can place a very clear stop on the trade and let it go. Also, the idea is that you're looking at a longer term chart and you're aiming to adjust your stop, you're aiming to stay in the trade, to try and catch a trend as it moves. So you've got to be accepting that you're going to see the market move your way and then pull back and then move your way and then pull back. It's not just going to, it's very rare that a market goes in a straight line. If you see that, it's possibly the end of the trade. So there are your key distinctions between the two. I'll show you a chart in a moment where it shows a very nice way that you could do it from a swing trade point of view, both a shorter term and a long term swing trade, as well as where a scalper would take a lot more trades, be a lot more dynamic with their trading, take a little bit more sort of consistent wins out of the market. So we'll have a look at that next. Okay, let's have a look at how swing trade and a scalp trade would be different and how different participants are going to hold on to trades or look to take smaller trades as the day goes on or the time period goes on. So what I've got here is a gold chart. The bottom left chart is a daily and the main chart is a 60-minute, so essentially a zoomed out version, or a zoomed in version I should say, of the daily chart. We're looking basically at this portion of the chart here, and what you'll notice up here we have got a double top on the gold. So there's your opportunity in that we could be looking for a big swing on the close below this low here, confirms it, and then you could be looking for a potential move right the way down for a new low. That's on the daily time frame. When you take it into an hourly, because swing traders can vary, you can have a more intraday type swing or a few days versus a larger trade or a larger sort of trend swing that you're looking for. So on the hourly, again, double top up here. Confirmation, if you remember back to technical day, is the close below that low. So the swing trader has got their entry here. They've got the close below the low. They're now looking for a short. Incidentally, this also coincides very nicely with this uptrend break that you can see on the hourly chart as well. So that's got the swing trader short. The swing trader is sitting there with a stop up above the double top, target a minimum of this low here, this 1,198. Larger time perspective, is going to be looking for a break of that, and that's going to get the next leg of the swing on. So your swing trader is not going to be worried about this bounce here at all. If anything, this could be an opportunity to sell more. It doesn't get back to the original entry, but you get this swing rebound trade. The candle makes a push up, totally rejects and closes back inside the previous candle. This gives a place to add on to your trade, and you quite quickly see the move down right the way through those 1,198. So part of the trade is achieved. For the swing trader, however, you're then looking at how you can trail your stop. So if you take it back to the most recent swing, which would be this high here, if you trailed a stop here now, so you could have scaled something out on the 1,198 and then trail a stop higher. You get a secondary swing and another move lower. This then brings in a new chance to get in a trade on the close below those 1198s, and this is how you can hold on to a trade for a longer period of time. The shorter term swing trader who's looking at this from an hourly may well then look to get out here, but ultimately the trade is not over until it gets up to that most recent swing, which is up here. So if they are really trailing that stop, they're still staying in the trade. So that's the way a swing trader is looking at it. Also, what we then get is this bounce here. Very nice. It's the 38% retracement of the move down. It is also bang on that previous low as well. So that gives you an opportunity for a secondary short. This is a trade that both a swing trader and a scalp trader is highly likely to take. You've got a couple of previous supports over here. So for the scalper, this makes quite a lot of sense. Perhaps not for a large move, but they may be looking just to run it back to these previous highs just here.
a little bit of support again around 1,193. So just like $5 move that the scalper's looking for. A swing trader may well be looking for this to completely turn over. And this is the difference. A scalper is going to be looking at all of these smaller trades. They're going to be looking at an opportunity. They see this rejection candle here. It then holds a level here, the 1198. Holds again. There's going to be a trade on for the scalper to take this as a buy. May well have taken this and got stopped out, depending upon their risk parameters. So there you've got a couple of trades for a scalper. They're still going to be looking at some of the swing trades as well. Again, these rejection type trades, they're going to be looking for that to turn over for a little bit more of a move. But again, they're not looking to hold this for long periods of time. The scalper wants to see the trade move on side, give them some kind of confirmation, perhaps off the ladder. So that's how the difference is going to be working. Scalper is highly likely to have got caught out on that trade there, looking to sell this previous low. They get caught out and get stopped out on that rush up, and that, despite the fact it rejects, is going to be perhaps enough to stop out a more scalping based trade. However, this is where you can't be deterred. You get the trade again here and it works, and again here it works. So continuing to take the trades on, the trades that you know are right. You may get proved wrong a few times, but ultimately, over time, if your trades and your trading strategies are good, as a scalper, you're going to be able to take all of these smaller trades out of the market. That is essentially the big difference between the two.
Next up, event and systematic trading, two entirely different styles. First up, with event trading, you do need to have a very strong fundamental knowledge. So you've got to really understand geopolitics, central banks, all of these type of things, and also what markets it's going to affect the most. I'll give you an example. At the moment, we're at the beginning of 2017. Any tweets from Donald Trump are becoming very important for the Mexican peso. So it's understanding that at the moment, the peso is the market that's in play. This may well move if things start to change, and you have to be able to shift and understand what market is going to be the most affected by that fundamental news. It is still very time intensive as well. Reason for this is you don't know when the news is going to come out, so you've got to still be at your desk to make sure you take the chance when it comes. But it does require that patience, that there's not going to be much trading to be done in between, and so it is just all about being patient for the right moment and then knowing exactly what you're going to do. And that's the key, knowing exactly what you're going to do and executing it to the plan. Build scenarios. This is how you do this. If this happens, what are you going to do? What are you going to trade? What do you expect the market to do? You've got to have all these plans in your mind and understand how the news comes out as well. For example, when earnings come out, what bit do you need to be looking at first thing, and then react straight off that? So have those scenarios built. This is a larger risk strategy for two reasons. One, you're going to be using a lot more size on the events, so you do have a risk there that if it doesn't go your way, then you've got a risk that you're using a lot of size. It is also a lot of risk that you can spend a lot of time not actually making any money until the events happen. So there is that time risk there, that you're sort of without any money, and then the expectation is that you make a lot of money when the opportunities come up. This does then put pressure on the opportunity, because you've got to make the most of it, because they come around infrequently. So it works for some people, but it is a tough strategy to implement and does still require a lot of patience, and then an ability to accept that pressure by knowing and understanding your scenarios and reacting accordingly. Completely different to this, however, is a systematic type of trading. This takes out all intuition. It is entirely rules based. So you will have your trades, you will have a very clear idea of what the trade is, where the entry is, where the stop is, where the exit is. The key to this type of trading is you have to execute it every single time. Reason being, if you start using discretion and getting out of trades, because you've tested the trades to work, if you then start using discretion, you're actually stopping the trades from working. The difficulty is, even if in your mind you know that it's not going to be a good trade, the system says you've got to do it. So the overall validity of the system rests on doing every trade. So that's where it's very important. It is research intensive. It is going to be spent a lot more time going through charts, perhaps building algorithms or some kind of testing software. So if this is what you're more inclined in doing, if this is the slightly more perfectionist route, you're a lot more interested in the research side of it, then systematic trading is perhaps more the way to go. And so it can be a little bit less time intensive in the fact that you can spread your time when you're doing the research. You don't have to be sitting watching the markets as they open to the close. Biggest risk with systematic trading is your correlation risk. This is the fact that you may have a lot of trades that are done in multiple markets that essentially are the same trade. So if you get some kind of fundamental event-driven news, this could put all of your trades offside at once. That's the big correlation risk with systematic trading. But definitely something to consider. And this is what you've got to weigh up, each of those 4 types, what suits you best, both in terms of time, your ability to take on risk, your willingness to take on losses, and your willingness to sit with a trade. They're the key things you've got to be looking at. And of course, what you enjoy. If you enjoy the event-driven stuff, that's probably the place that you need to be. If you enjoy more research-based, then systematic's the place to be. So let's move on, and we'll go and actually have a quick look at strategies after I just run through just a brief summary of the style. Created a table for you. This is more just something to take away. Gives you a quick summary of the requirements for each style, based around your time, risk, frequency of trading, and how much discretion you've got. So see how you fit into these things. This could change over time, and see if there's other areas or other styles that you want to start implementing into your trading. So take this bit away with you.